one of the things that we were talking about is, and you mentioned this earlier. Hey, you're the head of the derivative strategies, and that means, with an earnings season still in swing, you're looking at these higher implied volatility numbers as the
Yeah.
uncertainty rises. Hey, I mean, you talked about the good side. There's been a lot of 10%, 20% gainers, but there's also been some like Meta where they get just clobbered, and even they start one way and end the other,
Yeah.
which is
Oh,
even more
AMD
fun.
today. Like, look at AMD's trading
Yeah.
today. What really interesting. I mean, overnight that thing looked like it could go 6, 7%, even 10% down. Kind of if it followed right the same path
Mhm.
of some of the other semiconductors that had reported. I mean, well, look. Number one is they reported really good revenue, really good earnings, and actually a pretty darn good outlook. It's just these stocks are priced for perfection right now. Let's just be
Yeah.
honest. That's the hard part is they have to meet, they got to beat, and boy, do they have to raise. And
Hmm.
that was the case where they checked off a lot of those boxes. And I think what happened throughout the course of the day, and you could see that just in terms of kind of that last bar there, is that we started down, and throughout the course of the day, just built up some momentum and kind of rallied all the way through. Now, the close wasn't as strong for the market, or wasn't as strong, for some of these sectors as well. But overall, yeah, there's just been a lot of volatility around these earnings.
Absolutely. So what is a trader to do? I mean, again,
Yeah.
because you had the derivatives, certainly options can, come in because they are tied to that implied volatility. That's part of the price, right? If you know your deltas, not your deltas, your Greeks, then that's part of the
Mhm.
formula there, the Vega. So how are you kind of approaching earnings in a way to, I guess, sometimes hedge, a position that maybe you want to keep,
Yeah.
but you just don't want that volatility. You just want to survive, and sometimes that's what it's about. You want to survive in the position so that you can get the long-term capital gain, or what have you, whatever your strategy is.
Yeah.
So what are some of the strategies that you're kind of sharing with your folks there at Schwab?
Sure. Well, I mean, one of the things is we do a lot of spread strategies. We talk a lot about, whether they're selling put spreads, selling call spreads. When you have implied volatility high like it is right now, spread selling strategies tend to pay you a little bit more in terms of the credit. I think the hard thing sometimes with the spread selling strategies is when you get that outsized move, right? When you're
Yeah.
when it moves beyond what the market's expecting, as Meta's being a perfect example. Those spreads can widen very quickly. So
Hmm.
it's a bit of a challenge sometimes to do so. The other thing we look at is like time spreads, like calendars. Calendars tend to
Hmm.
do well when volatility is beginning to expand. And if you can find, if you believe that maybe a stock that you own has the potential to sell off, but as you mentioned, you don't want to sell it. Buying a put calendar is a way to kind of lessen the blow of that pullback without you having to sell the stock out. The hard part is this: if you just buy options, right? If you're looking to just hedge an option just by buying a put against some of the stocks that you own, remember when you go into earnings, that implied volatility goes up. And another way to kind of think of implied volatility is just the price, right? So you're
Hmm.
spending more for that hurricane insurance right before it's about to hit the coast, and that's that's
Right.
that's really what happens during your earnings cycles, that the cost of these options goes up. So there are things that you can do. And one of the things that I tend to look at in terms of a hedging strategy is collars. And I don't employ collars, and I don't recommend collars all the time. But
Hmm.
if you got a stock that's been really volatile, and here's the kicker: if you see that the call prices are getting bid up, meaning that people are willing to pay more and more for that upside, you can do something like this. You can find collars on stocks where there's zero cost,
Hmm.
equidistant, or in the case of the example that I showed you, or that we can talk about here, you can find it where you can actually get about a $8 move in protection. And giving yourself $10 upside, so there's actually a little bit more room for the stock to run before that protection kicks in on the downside. So that doesn't happen very often, but it happens when you see what we call call skew, when traders are willing to pay more for the calls than they are for the puts.
walk us
Yeah,
through, because not
exactly.
everyone in our, we're very stock focused, so not everyone's going to be
Yep.
familiar with the callers. We do talk on our shows a lot, especially
Yeah.
Harold Morris, one of our panelists. He talks about spreads all the time. He loves his credit spreads, especially. But so
Yep.
what is a collar? And I'm also going to ask you to define call skew so that we know what we're
Sure.
talking about
You
here.
got it.
Mhm.
You got it. You got it. So a collar is basically a combination of a protective put and uh, a covered call, if you will, right? You own the
Uh-huh.
stock, you buy a put, and you sell a call. And the idea is you're financing buying that downside protection, right? Because if I'm buying a put, it's you basically what you're saying is if the stock goes down to this level, I want to have the right to sell it. I want that protection to
Mhm.
kick in. So that is what, your long strike would be. Is that's the put that you're buying. You're selling
Mhm.
the call up above where the stock is currently trading, and you're doing that as a way to use the credit you collect from that call to pay for to finance the put that you're buying. Now, in normal circumstances, we have what we call investment skew. And so we'll get to kind of the definitions here, Justin. So investment skew means this. If you think about traditional portfolios and who's the bigger players in the game, right? Whether they're insurance companies, whether they're pension funds, whether
Mhm.
they're hedge funds, traditionally they own stock. They're long stock, and they protect that stock by buying puts, just like we talked about, creating that floor to where they have that protection kicking in. Well, in
Mhm.
order for them to pay for that floor, that protection that they're buying, they tend to sell calls up above to help finance that. Now, if you do that enough times, right, that put's going to be more expensive than the call. So you start to see what we call put skew or investment skew, meaning that people are willing to pay more for the protection than they're
Mhm.
willing to collect, for that premium that they're selling the call. They do that because think about it this way. The market takes a staircase up and the window down, right? That's what tends to happen. So they want to protect against that catastrophic drop out of the window. That's why they're buying the
Mhm.
puts. What
Mhm.
happens when you get this call skew is, and you can tell I'm Italian, you can see by the hands here, right? They start to kind of turn this thing around where they're willing to pay more for the calls because the expectation in their mind is that there's going to get a big payout from a big move to the upside. And so what I
Yeah.
thought it was interesting about Marvell is Marvell has actually beaten its earnings for 8 consecutive quarters, but the results in terms of the stock performance the next day is all over the map. So it's been very spotty. You might think that, hey, you get an earnings beat 8 consecutive times, you're going to see that stock rally 8 consecutive times. Well, that's not the case. And if you look at what happened, there you go. You can see that big gap on that last earnings, where the stock really kind of tanked. And
Mhm.
if you look at kind of that level, yep, there it is right there. Yep, you can see two different examples there. If you look at that level where we're at right now, we have rallied 50% from that last earnings low price of $62 after the shares sold off, 18% kind of on that earnings news. So we've rallied and we've gained and we've actually, taken out that previous high and we set a new high at least in that period. So going into earnings, which are actually coming out on December 2nd, you know, if you own these shares and you had that 50% move from the bottom, and it's hard to pick the bottom, but let's say you were waiting for an entry signal, you got above maybe that 20 or the 50 day, and you're still, you still have had some upside on that name, and you want to protect against a big move to the downside should it fail, to move up on earnings again, then a collar in this example might be, the trade that you're looking for. So here's what I'm looking at. The 87 puts in December 5 expiration. Why am I using the December 5th expiration? Because that encapsulates that earnings, right? So I don't want to do anything before that because then I don't protect myself against the earnings drop. And if I go too far out,
Mhm.
well, then the calls aren't going to be as expensive as they are right now. So the financing for the collar wouldn't be where it's at right now. What I'm doing with this, Justin, I'm just protecting against one event. I don't want to do this every month. I don't want to do this for the whole year. Just want to do it for one event. It's the event risk. So if I buy the 87 put in the December 5th expiration and I sell the 105 call, I can actually do that for zero cost. Meaning what I'm selling the call for, finance is buying that put, and there's actually no debit in my account at all. Gives me the ability to have that upside to
Hmm.
105. And then if the stock drops below 87, I'm actually protected for the move down below that because I'm long that put. And that's the type of stuff that we look at through our education. That's the type of stuff that we do on our webcasts with Schwab Coaching, is we show these kind of intricate, kind of hedging ideas. And you talked about credit spreads. I mean, that's the type of stuff that we talk about because that's the type of stuff that our clients want to know about.